Brand and consumer preference shifts. Consumer tastes in alcoholic beverages change over time. Trends toward craft, low alcohol, or alternative beverages can impact demand for legacy and premium brands. Constellation must keep innovating to remain relevant. Regulation and alcohol taxes. Alcohol is heavily regulated. Government policies, excise taxes, minimum pricing laws, and public health campaigns can affect consumption and profitability. High input costs and supply chain pressures. Constellation relies on commodities like grains, cans, glass, and bottles. Volatility in input costs or logistics disruptions can squeeze margins, especially if pricing can't keep up. Currency and international exposure. While most sales are in the U.S., foreign earnings still expose the business to currency fluctuations and local economic shifts. Valuation premium risk. Constellation is often viewed as a premium beverage company with strong brands, which can lead to a valuation premium relative to peers. If future growth slows, that premium could compress. Before we look at future opportunities, it's worth understanding some of the challenges Constellation Brands has faced over the past 5 years. Brand portfolio and repositioning. Constellation has a strong portfolio of premium alcohol brands, but shifting consumer tastes, especially toward craft beer, low alcohol, and alternative beverages, required strategic repositioning. Sometimes adjustments came slower than needed, which limited market share growth in certain segments. Investment in the cannabis business. A few years ago, Constellation made a large investment in the cannabis sector through a partnership with Canopy Growth. This distracted some capital and investor focus away from the core alcohol business and created volatility in earnings expectations. While the company has since scaled back parts of this strategy, the timing and execution of cannabis investments were a significant distraction. Input cost and inflation pressures. Like many consumer goods companies, Constellation saw rising input costs for commodities, packaging, and transport during inflationary periods. Passing all of these costs to consumers without affecting demand was a challenge. Supply chain disruptions. Global supply chain issues, especially during and after the COVID era, affected production planning and delivery timelines. This sometimes led to localized stock shortages or elevated costs. Premium pricing versus affordability. Constellation's focus on premium brands is an advantage in many markets, but in price-sensitive segments, especially when consumers' disposable income is strained, this premium positioning limited volume growth compared to value-focused competitors. Together, these issues help explain why Constellation's growth was more muted at times, despite strong brand power and long-term fundamentals. Now let's look at the key opportunities for Constellation Brands going forward. Premium beer leadership. Constellation owns some of the strongest premium beer brands in the U.S., including Modelo and Corona. These brands continue to gain market share as consumers increasingly prefer premium and imported beers over mass-market alternatives. Trading up consumer behavior. Even in a slower economic environment, many consumers choose to drink less but better. This trade-up trend benefits Constellation, as customers are willing to pay more for quality, brand recognition, and lifestyle appeal. Pricing power and margin expansion. Thanks to strong brand equity, Constellation has the ability to raise prices without a significant drop in demand. This pricing power supports margin stability and long-term cash flow growth, even during inflationary periods. International brand expansion. While the U.S. remains the core market, there is long-term potential to expand select brands internationally, especially in premium beer and spirits categories, leveraging global recognition of Mexican beer brands. Capital returns to shareholders. With strong free cash flow generation, Constellation can continue returning capital to shareholders through share buybacks and dividends, supporting total shareholder returns even if revenue growth moderates. Let's take a look at Constellation Brands' valuation and long-term performance. Over the last 10 years, the stock delivered an annualized return of 1.5% including dividends, which is relatively modest and reflects periods of valuation compression and uneven earnings growth. From a valuation perspective, Constellation trades at a P/E ratio of 23.5, which suggests a premium valuation compared to many consumer staples peers, driven by its strong brand portfolio and premium positioning. The stock has a low beta of 0.44, indicating lower volatility and defensive characteristics, which may appeal to long-term investors seeking stability. On an enterprise basis, the company trades at 12.1 times EV to EBITDA, while net debt to EBITDA sits around 3, highlighting moderate leverage that needs to be supported by consistent cash flow generation. Profitability remains solid. ROIC of 14.1% shows efficient capital allocation, while net income margins of nearly 12% and gross margins above 52% reflect strong pricing power in the premium beer segment. Finally, price to free cash flow of 14.5 suggests the stock is not cheap, but not excessively valued either, assuming margins and brand strength remain intact. Let's finish with the dividend and the overall investment takeaway. Constellation Brands currently offers a dividend yield of 2.78%, which is not high compared to traditional income stocks, but still attractive within the consumer staples and beverage sector. The payout ratio of 64.8% indicates that the dividend is reasonably covered by earnings, leaving some room for reinvestment, debt management, and potential future dividend growth. From an investment perspective, Constellation Brands stands out for its strong premium beer portfolio, solid margins, and defensible market position. However, long-term returns have been modest, and the stock trades at a valuation that already reflects much of its quality. In summary, this is a stock that may appeal more to quality-focused and defensive investors, rather than those seeking high growth or high dividend income. As always, this content is not investment advice. If you enjoyed this analysis, leave a like, subscribe for more long-term stock breakdowns, and let me know in the comments. Would you own Constellation Brands at today's valuation?